Okay, so now what? Nvidia was a bust. Not the company itself, nor its earnings and forecasts. Those were all stellar. But they didn't provide the type of buying boost and turnaround that everyone was expecting this past week. Instead, stocks continue to lose ground. Bitcoin keeps getting crushed. It's down by roughly a third in just 6 weeks. What is going on here? And the answer comes to us from the cockroaches and the owls. There is more to this blue owl hedge fund story. Plus, Bitcoin is corresponding pretty strongly with something we call the triple hooks. And really, the threat of Gunlack's garbage lending just won't go away. If anything, the pressure keeps getting turned way up. It hasn't hit 11 just yet, but the dial is being cranked higher, and we can see that it is in all of these developments like the ones that we're going to get to with Blue Owl. So the potential for going to the max has a lot of these markets on edge. Of course, you won't get any of this from the mainstream media. I mean, seriously, CNBC and the like are filled with stories blaming Bitcoin on Jeff Schmid, the Kansas City guy who has apparently foiled the Fed's December rate cut for his baseless tariff inflation quest that I went over yesterday. I mean, seriously, it has no basis in fact and certainly not in the markets. We're supposed to believe that Bitcoin has lost a third of its value because the Fed may not lower rates by a quarter point next month. If that sounds ridiculous, that's because it obviously is. No, there is a lot more going on here. And Blue Owl, right at the top of everything. Not because of the one fund that has been merged into the other, which is now not being merged, why it was going to be merged, and then what happens when it won't be merged, that's what we're really talking about. So Blue Owl, hedge funds, cockroaches, plus these credit spreads that I mentioned, they have a better window on what's going on in Bitcoin. And Bitcoin itself is a window going into all of this other stuff hidden in the shadow. Beside the December rate cut, according to the bond market, that's not off at all. So what we're hearing and what we're getting is a whole lot of risk aversion. Sound familiar? Now, I did a live video on Wednesday, even before Nvidia came out, and I started by basically saying the biggest news events this week would have nothing to do with AI or chips. It was Target, it was Home Depot, and what turned out to be the bad news of Walmart's big good news quarter. Everything is riding on the economy, on the labor market. Flat beverage is king right now, not Nvidia. Well, as it turned out, that was absolutely true. Wednesday night, Nvidia blew away with its earnings and forecast, all the important metrics and numbers. And after a short-lived rebound, it all fell apart almost immediately Thursday morning. The selling came roaring back all over the markets. And so here's the recap from CNBC. The Dow Jones Industrial Average fell 386 and some points, or 0.84%, to settle at 45,752.26 after rallying more than 700 points at the session highs. The S&P shed 1.5% to end the day at 6,500 and change, despite rising as much as 1.9% earlier in the day. The NASDAQ fell 2.16% to finish at about 22,000, down from a 2.6% advance at one point in the session. Huge turnaround on Thursday morning. Nvidia's reversal dragged the broader market down. Shares had gained as much as 5% after the chipmaker released better than expected quarterly results and an upbeat fourth quarter sales forecast. However, the stock ultimately closed down 3%, so from plus 5% to minus 3%, despite CEO Jensen Huang's reassurances that demand for its current generation Blackwell chips are, quote, off the charts. He also rejected the idea of an AI bubble, though what else is he going to say? I mean, he's not going to say that it is. So why didn't Nvidia's Grand Slam provide the support and the basis for a market turnaround like everyone was saying before Thursday? Well, CNBC has some theory about that. So back to the article. Stocks fell on Thursday as a market-wide rally sparked by blockbuster Nvidia results and guidance gave up steam, and as investors lost hope that the Federal Reserve would cut rates again in December. So I'm going to pause here and give you a second to stop laughing, because we're supposed to believe that if the stock market, which said beforehand everything rested on Nvidia, and then Nvidia gave the market everything it could have ever wanted and more, but that wasn't enough because maybe Jeff Schmid at Kansas City won't allow the Fed to cut by a quarter point in December? It really is ridiculous, but that's what the mainstream wants us to believe. In the absence of what the mainstream doesn't have as an explanation, it's always got to be about the Fed, right? I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video. And now let's get back to it. The truth is, the mainstream media can't make sense of what's going on, so they simply default back to the Fed like good little parrots. We're taught and told that the central bank is the all-powerful force, so if something happens that you can't immediately and perfectly identify the cause, then it's got to be dear Jay Powell. See what I mean about how the Fed really works? It's all superstition. It's all psychology. What's really going on has nothing to do with the FOMC, apart from the fact the FOMC is going to have to respond to it, which is where the rate cuts are coming from in the first place. The Fed doesn't lower the Fed funds policy to fix a problem. It responds to the problem and then sells the response to you through the worship of those like CNBC and Bloomberg. Now, all that said, and all that, keep that in mind, let's start talking about the stuff that does matter. And by that, I mean the intersection of cockroaches, garbage, and the Right Honorable Lord William Henry Beveridge, the first Baron of Beveridge. Now, Dr. Beveridge is, of course, just a reference to the Beveridge curve, which we've been using as a shorthand for a labor market that is experiencing increasing difficulties to the point it's on the cusp of, if not already over the edge of, job losses. And all the data continues to point to just that, including Thursday's release of the long-delayed September employment figures, which I went over in a video this past week. If you want a quick partial explanation why stocks and risk assets struggled on Thursday, this is it. Not the payroll numbers themselves, and certainly not the obviously overstated, once again, September headline figure. We've now got two negative establishment survey numbers on the board and a whole bunch more, which says the pair are not going to be the last of them. It was more confirmation of the flat part of the Beveridge curve. And the more confirmation we get of that, the greater the negative implications, and not just for the general economy. Besides potentially worsening layoffs and, get this, even less hiring, which is actually still possible, believe it or not, there are the consequences for credit markets, particularly struggling private credit firms or shadow banks, whatever you want to call them. What does the Fed call non-depository financial institutions? The more we see of Baron Beveridge's labor curve, the more cockroaches we're going to discover that are attempting to scurry out of the bright light of illiquidity. The reason why is the garbage lending that so-called bond king Jeff Gundlach talked about earlier this week. Quite simply, the worse the labor market gets, the more losses that are going to pile up in private credit, the more cockroaches that get created, and the bigger problem that we'll all have trying to handle everything. That's where we are already. We've seen the bankruptcies. We've seen the common theme about collateral abuse. It's undermined and eroded trust in private credit, the entire space, because of, number one, the garbage lending that we all know went on for a long time under the cover of Jay Powell's always Goldilocks scenarios and interpretations. But the bigger reason trust is being lost is simply no one will provide any information that what I just said is actually wrong. What they're all doing is what they always do in these credit cycles. They tell you how wonderful the portfolios they're running are performing and how solid the fundamentals, not prices, how solid the fundamentals, their view of the fundamentals are in those portfolios. It is quite clearly the runaround, as the Bank of England's Governor Bailey stated back when he was, asking questions in the wake of the few cockroaches and telling Parliament in the UK about the whole thing. This whole thing ends tomorrow. It ends tomorrow. If private credit providers open their books, invite the entire world into these portfolios, let everyone poke around and scrutinize every last detail and position. Don't tell us the portfolios are strong. Show us. We all know they won't. What's more, we all know why they won't. This isn't difficult to comprehend. Gundlach was right. These things are riddled with garbage. If anyone opened their books, it would actually lead to a stampede. So the best they can do is spit out the positive generalities and put some happy faces on it and try to calm everything down, try to calm an increasingly agitated investing public. But that only works so long as the increasingly agitated and even angry hedge fund investing public doesn't ask for its money back. Once you get to the R word, redemptions in this case, that's when all bets start to come off, because once you get the redemption request, That means the bigger escalations, the forced selling, the price discovery that may not discover prices that are good for everyone, or even good for the entire space. That's because these funds are fully invested and highly leveraged on top. They don't have the spare cash just lying around. If a lot of investors go to management and say, we want out, the fund's got to sell some assets in order to get the cash to pay off the investors. They might be able to borrow some to pay back the hedge fund investors, but that can get dicey too. In normal times, though, this really isn't a problem. Markets absorb selling. That's what they're supposed to do. Even esoteric and complex assets. In a benign environment, you can almost always find some liquidity. But in abnormal times, you try selling increasingly smelly assets, you're not going to get the prices that you need. So redemptions in a bad market force selling that pushes prices down, which makes everything look worse because those prices are used to judge and color what everyone else has. So forced selling by one fund undercuts the perceived value of all the funds in the same credit market sector, and if it gets far enough, it goes even beyond there, what they call contagion. When market conditions get to be that bad, the only choice you have is to try to stop the selling in the first place before it even happens, which means blocking redemptions right from the start. And this is where we pick back up with Blue Owl. Now, earlier this month, the alternative asset manager announced that it was going to merge one non-tradable fund with its larger tradable fund, and it raised a few eyebrows when it did, but the feces really hit the fan earlier this week. Now, the company itself said this was going to be done because there was really no need to have two separate funds doing basically the same thing at the same time. So why not? Why not just fold the one into the other, eliminate some of the duplicate costs, and save everyone from complication and unnecessary administrative expense? But earlier this past week, investors found out they would be prevented from getting any of the money out of the one fund, the non-tradable one, while the merger process was being completed. In other words, they would be stuck in the non-tradable fund for months. So you can see where this is going. It had nothing to do with creating efficiencies. After all, Blue Owl had already disclosed that they were getting redemption requests, and they were huge redemption requests back in October, the month where we really got infestation with cockroaches. So this fits with the other names that I brought up to you recently, including UBS's O'Connor funds. So what Blue Owl's proposed merger did tell us was that there were indeed other funds being pressured by this R word of redemptions. It wasn't just the UBS ones. That's the real reason for the merger, to block those redemptions, to avoid having to sell likely garbage assets into a market that's now very aware of the smell thanks to all the confirmation from flat beverage. Now, what brought this Blue Owl merger into the public eye was how it would have forced investors in the smaller non-tradable fund to get the bigger traded fund's value on the conversion. And since the traded fund was trading at an enormous 20% discount, the merger was like forcing maybe up to a 20% loss on those investors. And as I showed you a couple days ago, immediately the lawyers started seeking class action status. The threats of lawsuits were everywhere. And in light of that, plus all the really negative publicity, Blue Owl almost immediately backtracked. The merger has since been called off. Nah, never mind. No efficiencies needed. Quote, Blue Owl has decided to call off the merging of two of its private credit funds after the deal caused some angst among investors, according to people familiar with the matter. The boards of the two firms did not see the benefits of merging the funds as outweighing the volatility and negative headlines that came from news of the deal, according to these people. Therefore, they chose to reverse course, the sources said. And remember, the only real benefits of the merger were to block redemptions for several months, hoping that would be enough for the situation to calm down, thereby preventing forced selling into a garbage-detecting marketplace. It was really a form of extend and pretend. Because, again, forced selling from the one fund, even if it was much smaller, the lower prices it almost certainly would have gotten for any assets would have tainted everything, not just the fund in question. The lower prices would have tainted perceptions of how much garbage there is in the bigger Blue Owl fund, and it would have spilled over much farther to even other hedge funds. It could possibly become systemic. If this one little fund is forced to sell at lower and lower prices, therefore creating actual losses, the chances of seeing that repeat in fund after fund go way up. At least that's the perception. A lot of times it's correct. It becomes a problem for the entire private credit area, especially with a fund with a name like Blue Owl that is so widely known at this point. So here's the thing, the whole thing right here. The fact that we'd even attempt to pull off what was very clearly a bad idea shows you how serious the situation must have been or must continue to be. If this is what they decided against all other options, that there really weren't other options, just this bad merger idea that was going to clearly cause problems, if this is what they chose to do, it tells you the situation has deteriorated, which we already know from the other funds that we've been talking about and the situation overall, the cockroaches, the garbage, all the stupid coming down. We already know that it's getting serious, and here's more proof of it. It's not just this one fund. It's not just Blue Owl. It's Blue Owl as the latest escalation and a whole bunch of other stuff that's going on behind the scenes, stuff that's related to the macroeconomy, the flat beverage. Okay, now what? The merger's been called off, so what happens now for at least Blue Owl? Well, we know the answer. It's selling. Let's go to Bloomberg here. In an interview with Bloomberg on Wednesday, Packer from Blue Owl said that the fund has performed well. What else is he going to say? And that Blue Owl will work with the fund's board to figure out a liquidity solution for investors. Quote, all options are on the table, he said, including listing the fund or selling assets. There may be other options that we may come up with within the next few months. Translation, they're going to do everything they can possibly think of to avoid having to sell assets in order to meet these redemption requests that we all know are going to come flooding in. And the only reason they don't want to sell assets is because they also know the market isn't there for them. Another huge clue, another big thing in this entire Blue Owl saga. Even though we don't have nearly enough information, specific information, we are getting confirmation, even if it's in the form of just insinuation. Maybe Blue Owl can arrange some financing so the assets can be preserved, but who in their right mind is going to lend to this fund that's being bled out and is likely stacked with garbage? You see the problem? And like Jamie Dimon said, there are more of these cockroaches, not just this one owl. Okay, we get all that, but what does this have to do with Bitcoin? Bitcoin seems a long ways away from something like Blue Owl, private credit, and the garbage lending in the shadow banking realm. But before answering that question directly, let's talk about credit spreads. By that I mean the measure of rates on junk corporate bonds, those that trade in liquid markets, liquid relatively speaking. The spread simply measures how risky the market perceives that part of the junk corporate segment. When spreads rise, that tells us there's less willingness to take risk. And when the spreads rise quickly, that tells us there might be some urgency behind selling, maybe even liquidity pressures, all their own over here in high yield. In other words, rapidly rising spreads are a sign of problems in junk corporate credit, which just might be in parallel to the more opaque conditions in, say, private credit. They might be a decent or even a close enough proxy. And if investors are getting cold feet and even selling in liquid high-yield junk, it's very likely they're doing the same thing with assets in the less liquid, almost totally opaque shadow credit markets. And that's just what we're getting in the visible parts. The riskiest class of junk bonds, what we call the triple hooks, or those bonds that are rated triple C and below, they have seen spreads rise, and pretty sharply. It's not overwhelming. It's not, oh my God, crisis level, but it is a significant and quick move here. There's not just selling, but more determined selling recently that's potentially encountering some liquidity issues on some of those sales. So really not a whole lot of good signs over here. And while the triple hook spreads have been rising for the past several months, really going back to August, the most determined selling and the clearest and fastest increase in the spread started on October 7th. And that date, or maybe the day before, should ring a bell. Because on October 6th, that was when Bitcoin hit its record high. There is a growing correlation between rising spreads in the riskiest parts of the junk market, and maybe a proxy for private credit, and the plight of Bitcoin. What that strongly suggests is that fleeing from cockroaches and the growing possibility of spillover from them, it's spilling over into other risk markets already. Remember, early October is when the details about First Brands and Tricolor began to spill out, which was followed by Zion's and Western Alliance exposures, Primalend, the telecom factoring fraud that I told you about almost no one else did, the cockroaches. Selling in Bitcoin isn't really about Bitcoin. The fact that it and all the rest of crypto being crushed is a reflection of the capacity to accept risk and the liquidity availability to continue doing so. And the more confirmation we get of flat beverage, the greater the pressure on all of these things. More redemptions on hedge funds, maybe some selling from them, selling in risky junk credit, selling in high beta crypto, all of it together. But remember, it's not just the cockroaches. The worse the economy and labor market are confirmed to be, the greater the potential for losses all over the place, the more there are going to be redemptions, the more there are going to be consequences in liquid markets, and round this growing credit crunch will spin. It really is the intersection of cockroaches, garbage, and the Right Honorable William Henry Beveridge, first Baron of Beveridge. That is why Nvidia didn't spark the turnaround that everyone was convinced it would. It's about Target, it's about Walmart and Home Depot and the labor market and the household survey and the establishment survey, the confirmation of all the flat beverage curve. Beverage is in charge here, not Nvidia, nor Jay Powell and will he or won't he December rate cuts. And you could see all of those things in what Target and Home Depot and even TJ Maxx reported before we even got to Nvidia. Went over all of those details and the implications in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.